from then on, you build onto things like maybe something on stochastic rates modeling, etc. But finally, everything boils down to fixed income. And even those of you who would like to maybe move on to corporate finance or even funding side of things, even that is where a good understanding of fixed income is useful, because as we know that bonds form one of the components of capital as well. So a good clarity on that would maybe help you figure out when could be the best way to raise debt capital. That is, in case you are to slightly move away from your target debt to equity structure, and when would be an opportune time to do that, etc. So those are things which come handy, and I feel once you have good confidence on fixed income, it will help you explore a lot of other concepts. So that's why we'll spend a couple of more sessions understanding fixed income thoroughly, and then maybe we can try out bootstrapping, etc. Something which I want to do hands-on with you guys as well. So that is something which we'll do later. So let me share the same presentation. We'll continue the same thing which we started on Saturday. Okay, so types of bonds. So this is something which we have discussed. Now, a few types of interest rates which we popularly observe in the market. Because when you talk of an interest rate market, you generally talk of different benchmarks or different types of rates which are prevalent. And every rate has a separate purpose. So that's why you have so many benchmarks which are available. So first is treasury rates, or what you call as GSEC rates. So these are the rates on treasury securities, that is securities which are issued by the union government or central government as we call it. And uh, and this is something which is closely tracked as well. So have you guys heard of FIMDA as an organization? So was this introduced in maybe your financial institutions subject before? So FIMDA is Fixed Income Money Market Dealers Association. So you can visit their website as well. I think it's fimda.org. So if not, and this is another organization which works very, very actively in fixed income and FX space, I would say. It's not a regulatory organization as such, but it works very, very closely with the Reserve Bank of India. So yes, a couple of guidelines which FIMDA publishes, that is something which RBI expects banks to follow. So especially FIMDA's guideline around valuation of fixed income products. That is something which has become like a regulatory guideline for the RBI. So RBI expects banks to follow the same methodology, but FIMDA is an organization which publishes these GSEC rates on a daily basis. That is, at the end of day, every day, you have access to what the closing yields are on that day. So when I say the closing yields, that is tether versus yield. So you have certain tenors, let's say 1 week, maybe 1 month, 6 months, and so on, up till let's say 30 years. And you have these rates, or these are what you call as the closing rates. So this is what you call as a closing yield curve. So we'll talk a bit about yield curve in some time. But when you talk of treasury rates, FIMDA is something which always comes to my mind, especially from Indian markets perspective, because banks have their membership with FIMDA. So every day in the evening, they are going to fetch this matrix which FIMDA publishes, which is basically your closing yields on that day. And these are something which get plugged into your system. So it could be used for a variety of applications. So it could be maybe used for valuation, risk analytics, any kind of sensitivity measurements, etc. But this is something which we call as the GSEC, or the government securities yield curve, which is available for consumption. Next are LIBOR rates. Now LIBOR has phased out to a considerable extent. So except USD LIBOR, almost all of other LIBORs have gone away. So 31st December 2021 was the date when LIBOR ceased to exist for most of the currencies. Now, when I say most of the currencies, we always talk of 5 or 6 major global currencies. So we have USD, GBP, Euro, Swiss francs, and JPY. So these are also what you call as the 5 large currency areas. So along with this, for a few other currencies, LIBOR used to be published up till now, but that has stopped. Other than a few tenors on USD, LIBOR doesn't get published for other currencies anymore. So we'll talk a bit about that transition as well. So I think that's a part of one of the slides in this discussion. So we'll come to that in a moment. But to give you an idea of what is LIBOR, LIBOR stands for London Interbank Offered Rate. So this is the rate at which banks can lend to each other. And so this comes from your interbank lending market, because we know that banks actively trade with each other as well. And many a times for balance sheet purposes, etc., banks require to lend funds from each other. So they generally used to do it at a LIBOR rate. Now, since that has gone away, we are moving on to a new set of benchmarks, which we'll introduce in some time. But that is basically the idea of LIBOR. Now, the history of LIBOR and why LIBOR got phased out, etc., that is something which we'll cover in our subsequent slides. So, request you to hold on till then. Then you have repo rates. So, repo is nothing but a repurchase agreement. So I mean, a very popular instrument whenever we see, even from a plain equity perspective, repo can be something which we may want to do with our broker as well. So I may be in requirement of funds, so I could approach my broker saying that and I need to trade. So can we do something? So that time the broker will say, fine, and you, why don't you pledge some kind of collateral, and then you will allow you to trade as well. So let's say I do an agreement for one week. So at the start of the week, let's say I pledge government securities as a collateral. So at the end of one week, when I repurchase those securities, that will be at a slightly higher level. So why higher level? Because that is like a compensation which I need to make to my broker. So that is what you call as a repo type of a transaction. So banks also engage with the Reserve Bank of India in such repo deals or repo transactions, because whenever they have any kind of funding gaps or mismatches which they want to match, then that is something which they can do through the repo window which RBI offers. Next are overnight rates. So overnight rates are something which are prevalent for one day. So that's why we call them as overnight rates. And all of these are traded rates. So there are certain advantage whenever you have a certain rate as a traded rate. So later on, when we talk of the LIBOR transition, we will talk a bit about overnight rates and why they have become more relevant as compared to LIBOR as well. So we'll talk. So request you to hold on to overnight rates as well for some time. So when we talk of LIBOR transition, we'll study the LIBOR rates and overnight rates in detail, because all of the new benchmarks which have come in to replace all of these existing LIBORs, they are based on the idea of overnight rates. So that is something which we'll talk about. So request you to hold on to that point till then. Now, a few properties of any typical bond. So any bond you pick up, these are a few things which you'll always observe. One is a principal amount, or what we call the face value, generally 100 or 1000, but 100 is more common. Then coupon rate. So your coupon could be either fixed at 5%, or your coupon could be something like LIBOR. So it could either be a fixed or a floating coupon. Then payment frequency. So payment frequency again depends. Semi-annual is the most common frequency, but otherwise you can have annual frequency, and other lesser common are monthly. So monthly, semi-annual, annual, but semi-annual is the one which is extremely popular. You may have quarterly as well, but again, slightly rare. Most of your government securities pay semi-annual. Then maturity date, so your time to maturity is fixed, so capital T would be given. Then there is a day count convention. So day count convention basically talks about the number of days in a certain period. So imagine that I have a quarterly coupon paying bond, and let's say I'm looking at the first quarter, or I would say the last quarter for our financial year. So let's say I'm talking from January to March. So Jan, Feb, and March. Now, when I say a day count convention, that basically implies the number of days in a certain period. So popular day count conventions, they could be Act by 360. They could be Act by 365, something this is something which we follow in India. This is something which is in the United States. You can also have an Act by Act, etc. So all of these are also what we call as day count conventions. So why we require day count conventions is because we need to count this act which is there at the top. So you can also have something like fixed 30 by 360. This is also another convention which could be done. So the numerator basically explains the number of days which are there in each of these periods. So if I follow a 30 by 360 convention, that implies that if I have to calculate the number of days in this coupon period, I'll use flat 30 days. So it doesn't matter whether January has 31 days, whether February has 28 days, etc., or March has 31. I'll assume a flat 30 days, and this is what I can call as a 30 by 360 convention. Whereas if I go, let's say, the Act by 365 route, then I would have 31 days here, I would have 28 days here, and 31 days here again. So that way, and your number of days in a coupon period can change. And this is how your day count conventions get used. So these are conventions which are frozen. So generally for INR or even for GBP, we prefer Act by 365. For US dollars, it's always Act by 360. 30 by 360 is slightly less common, and again, Act by 360 is not very, very common. But this is the idea behind day count conventions. So is this okay?
Yes, sir.
Okay. Now, have you guys heard the term clean price and dirty price for a bond? Was this introduced at any point in time in any of your other subjects?
So did you mean embedded interest in the price? No, sir, it
Yes,
wasn't taught to
yes.
us.
Okay, okay. So when we talk of a bond price, there are always two components to it. One is a clean price and other is a dirty price. Now, clean price is something at which the trading happens. So whatever traded prices you see in, let's say, on FIMDA's website or anywhere else, they are always clean prices. So traders will always transact at clean price. Subsequently, they are going to exchange accrued coupon or accrued interest as we call it. Now, if I adjust clean price plus accrued coupon or accrued interest, then I get what I call as the dirty price. So traders would exchange dirty price separately, but the transaction, the actual trading will happen at the clean price. Yeah, so someone has raised their hand. Yeah, Mir, please go ahead.
So when you say clean price, does that mean at par value or something else entirely?
Uh, so it may or may not be at par. It depends on the price at which it is transacting. So you can imagine clean price is like the traded market price for the bond.
So, but then how it is determined? I'm curious as to because in bonds it is just at face value, no? Like 100 rupees bond is issued at 10% coupon rate, so it will trade at say 100 rupees plus the discounted interest rate factor.
So that will be uh, so so that happens whenever you are holding the bond till maturity. But if you decide to transact in between, then you will trade it at different prices, right? Because finally your bond price is dependent on yields. We'll talk about that in some time. So bond price will be driven by market yields, and during the life of the bond, yields can change. So if yields change, the bond price also changes. So that's how your clean price gets fluctuated.
Okay, sir. Thank you.
So we'll see bond pricing in some time. So I request you to hold on till there. Then we have a dirty price. So dirty price basically implies that I have to adjust for accrued interest or accrued coupon. Now, why do I need to do that? Now, whenever I am trading a bond, or so let's say I am holding a quarterly coupon bond, and let's talk of the same quarter. Since I've written this, we might as well use these dates. So let's say I have purchased the bond on 1st of January. So this was my bond purchase date. Let's say I'm a bond trader and I'm following for simplicity. Let's say I use the 30 by 360 convention to keep the calculation easy. So now what I do is for the next 2 months, I decide to hold the bond. So let's say I hold the bond until February. Imagine there are 30 days flat in a month, which I assume. And let's say I'm standing on February end, and tomorrow is 1st of March, or let's say today is 1st of March, and I'm transacting today. So now I have been holding the bond for the last 2 months, and let's say I had purchased the bond at that time, and my first coupon was also received at the time of purchase. Imagine that, let's say that date coincided, so my coupon was received. So my first coupon I received when I purchased the bond, coincidentally that matched. That may not match. To keep things simple, we'll say it matched our thing. So on 1st of Jan, I purchased the bond, I received a coupon. Now the next coupon due on the bond is on 31st March. or 1st of April, whichever way. That is basically a quarterly coupon paying bond. Now, I have held the bond for 2 months' time, and I still have 1 month to go before the bond coupon gets paid out. That is, I've held the bond for 60 days, but there are still 30 days to go before the coupon will be paid on this particular bond. Now, the thing is, I will not be eligible for this final coupon payment, isn't it? Because I am selling the bond today, which is earlier than the coupon payment date. However, I will have to be compensated for the part coupon payment. Now, why part coupon payment? Because I have held the bond for 60 days. That means I need to be compensated for the coupon, which is pro rata for that particular time period. Or you can say it's like a weighted average coupon for that much time period. Because whenever you say you have, let's say, a quarterly coupon of 5%, imagine. So if the quarterly coupon is 5%, it's not like single shot 5% has happened. It doesn't happen that way. It accumulates through the entire quarter. So every day, some portion of 5% gets accumulated, and then you take a cumulative sum which comes out to 5%. That is, your interest gradually builds on from today, which is day zero, until day 30. Oh, sorry, day 90, since it's quarterly. So here as well, similar logic will be used. So I'll see how much is my daily accrual which is happening from the day of last coupon, which was 1st of Jan, up till the day I'm selling the bond, which is 28th of February. So that 60 days, which I assume, this will be the time which I'll use for calculating how much is the weighted average coupon. So I may not be eligible for full 5% because full 5% is something which I'll receive after 90 days period. Because 90 days is the quarter period, right, for receiving the entire coupon. But now I have to receive pro rata for 60 days. So I simply take a pro rata number, how much is commensurate for 60 days, and that is what I call as the accrued interest or accrued coupon. So does this idea make sense?
Yes, sir. Sir, I have a
Was
question.
Yes.
yeah,
Yeah.
Rahul, go
Say
ahead.
for example, if I'm assuming 5% to be my rate at which I'm like, accruing this interest.
Hmm.
So if like, it's a quarterly payment, which means every 4 months. So would it
Three
be
months.
like every 3 months, sorry.
Yeah.
So would it be like because I've held it for 60 days and only another 30 days were left. So is it like 2 by 3 or 5% would be the interest that I would be accruing on this?
Yes. Yes. So
Right.
basically, the simple formula is you take your coupon and you just take a weighted average number. So you held it for 60 days. Again, naturally, you can't use days. You have to convert it into number of years. That's like a convention upon 90 days. And this is something which will help you calculate your accrued coupon. So a simple ratio, just taking our time up till which I have held the bond, and that's that.
All right, sir.
Yeah. Anyone
So,
else?
what's the reason behind having different conventions? Because everything is automated, right? And also, what kind of scripts trade under each convention?
So these are conventions which have been around for a very long time. Now, why these conventions are being followed, even I don't have the answer because I also use these conventions as they are. So generally, for every currency, these are the conventions which have been around for a very long time, and the market has accepted them. And for the foreseeable future, I don't expect these conventions to change. So, and something which has been around for a long time, that is something which the market is carrying ahead. So, I mean, is there any specific history behind why this, again, this convention? I'm not very sure. But this is something which we use directly. I mean, market uses these conventions directly, unless explicitly specified. So, unless your bond specifically says that although it's a USD bond, we want you to use Act by 365, then fine. Then you use Act by 365. Otherwise, if that is not specified, people will know by default that Act by 360 is the convention to be used.
Okay, and sir, where exactly are these conventions used? So like you said, USG versus ACT is usually used for India or something like that, right?
So for anything which is denominated in US dollars, you generally tend to follow Act by 360 convention. So a few applications
Okay.
for this can be either bonds, so any bonds which are denominated in US dollars, or it could be
Okay.
anything on your interest rate swaps as well. So whenever you have to calculate the present value of your swap legs, fixed and floating. At that time, again, this convention might be used. Even for things in which are sitting on your banking book, so something like a loan or overdraft. So those also follow a similar logic, isn't it? Because whenever you say that your loan rate is so much yearly, then that yearly rate is not a one-shot thing which happens. It accrues every day. So again, that is where that accrual thing, this thing gets used as well. So, so that way, I mean, these are a few places as to where these conventions will be used. Based on the currency, you just pick a certain convention and you use it in that application.
Okay, sure, sir.
Uh, then we'll talk a bit about GSEC and spreads as well. So again, request you to hold on to these 2 points for now. So when we talk of price versus yields, we'll talk a bit about yields and spreads and how exactly they interact as well. Optionality, this is something which we have briefly discussed the last time. So there are other features like call options, which call and put options embedded. So again, this is something which we'll be covering in our subsequent class. So I request you to hold on till this till then. So when we have discussed some more bits on fixed income, we'll try and relate this with options theory. So that way we'll be able to understand what is bonds with optionality. So understanding the concept, a few things or a few ideas which are very useful when it comes to understanding bond mathematics. One is YTM, or what we call as yield to maturity. So this is the most popular measure of bond yields. So whenever you read newspaper reports that bond yields have moved so much, they generally talk about YTM because that is like a standard thing which will be reported in newspapers as well. So when you say YTM or yield to maturity, that is something, or that is the yield which an investor will earn if he or she can hold the bond till maturity and also reinvest the periodic coupons at the YTM rate. So that is what you call as YTM, or generally, if you just say yields, people will understand that you're talking of YTM. So we'll understand how YTM gets related to the bond price in some time, but this is the brief idea behind YTM. Effects of compounding, this is already we have seen. So as the rate of compounding improves, naturally your corpus will also grow at a faster rate because your money is working harder for itself. So higher the compounding rate, higher would be the expected final payout. Then there is something which we call as benchmark yields. So which is the benchmark security in India?
GSEC T-bills.
Correct. So in GSEC, any specific security which you call as the benchmark security?
90-day.
Okay. Anyone else? Can you think from a bonds perspective, government security or treasury bonds? Which is that security which we call as the benchmark bond or a benchmark treasury bond? So a specific tenor which we call as the benchmark. Okay.
Sir, could it be the 10-year bonds?
Yes.
Because in the
Yes.
US, that's what we follow.
Absolutely. In India as well, the same thing. The 10-year GSEC is what we call as the benchmark yields. So whenever you read newspapers and they say that benchmark yields have moved by so and so, they're talking about the 10-year GSEC yields. So these are the some things. I mean, 10-year yields or the GSEC benchmark yields are something which are closely tracked by the market because they give a decent idea as to where the yield environment is heading. So whenever RBI issues new bonds, these are what you call as the new treasury benchmarks as well. So we'll talk a bit about bond issuances later on. So have you guys been introduced to the concept of primary and secondary markets?
Yes, sir.
Yes,
Okay.
sir.
And have you guys been introduced to the idea of RBI auctions?
No, sir.
So very
Okay.
briefly, yes.
Okay. And anything on primary dealerships?
Again, sir, like hardly 5 minutes or so.
Okay. Okay. So again, this, so maybe after a couple of points we discuss, or maybe once we discuss benchmark yields, we'll talk about these because having an idea of RBI options and what do primary dealers do is important from a fixed income perspective. So we'll talk about that as well. So maybe I'll include these points in the presentation when I share it across. So when you say benchmark yields, so a quick question: is benchmark yield real or nominal? So firstly, what's the difference between real and nominal? So something which might be covered in your economics class. Now, most of you will be from economics background, so you'll be familiar with it.
So inflation.
Correct. Good. So whenever we say nominal yields, you always adjust it for inflation. So always remember your benchmark yields are always nominal yields. So these can be like good interview questions. So in case you have to appear for any interviews in the coming months or even later on, this is like a given. So whenever you talk of benchmark yields, they are always nominal yields because it's always adjusted for inflation expectations. So this can be like those initial icebreaker questions in interviews. So they can quickly generally ask you why talking. I mean, talking of benchmark yields, do you think it's real nominal? So at that time, you should quickly tell them it's nominal yields, so that the further questions become easy and straightforward. If because it's always good to get these icebreaker questions cleared, so that other things then flow smoothly. Okay, so before we go to idea of interpolation, etc., let's talk a bit about RBI auctions, primary dealerships, etc. So RBI auction is something which the Reserve Bank does throughout the year. So if you go to RBI's website, rbi.org, you will find that there is an auction calendar. So not just RBI, but regulators globally as well, or central banks, I would say, not exactly a regulator, but central banks globally have a certain set calendar which they follow for auctioning of government securities. That is, they say that at these specific points in time, we wish to go in for a further auction of government securities. And the idea behind auctioning of government securities is they are raising money for the central government. Now, the central government by itself is not permitted to issue bonds. So they do it via the RBI route. So finance ministry, whenever they require funding, or whenever the union government requires funding, they do it via the finance ministry, which routes it through RBI, because RBI has the authority to issue bonds, since it's the monetary authority of the country. So RBI auctions happen at regular time intervals. So the idea of auctions is to raise money for the central government, and it could be for various purposes. So it could be for public expenditure, any kind of public welfare activities which the government has in mind, etc. So all of these things are happen through RBI auctions. So whenever RBI auction happens, that means bonds are issued to market participants. So those of them who are interested in purchasing the bonds will buy the bonds from the RBI, and for those bonds they are going to receive a certain periodic coupon. So most of the bonds are going to pay a certain periodic coupon, and most common frequency for government securities is semi-annual. So every 6 months you are going to receive a certain coupon payment. So this is what we call as a primary auction. And why we say it's a primary? So basically, what's the main difference between primary and secondary markets? Anyone?
So fresh issue and reissuing. So that is
Correct.
the basic difference.
Correct. Absolutely. So something which is issued for the very first time, it happens in the primary market. So an example can be a new bond which the RBI is auctioning, or from an equity perspective, an IPO share. So IPO share is something which did not exist up till then. So that company share did not exist in the market. They are newly entering the market. So that is also what we call the primary issue. So something which has never been traded in the market, that gets traded in the primary market, or it's introduced in the primary market, I would say, and subsequent trades happen in the secondary market. So whatever RBI auctions happen, they happen in the primary market. So that is the time when those bonds are freshly issued for the very first time. And once they are auctioned in the primary market, then everyone starts trading them subsequently in the secondary market. Now, as a part of the auction, you have an important entity which you call as a primary dealership, or primary dealers as we call it. So primary dealers are those people who would be participating in almost every RBI auction. So they give a commitment to the RBI that we will participate in such and such an auction, and we will purchase certain quantum of the offering which you're doing to the general public. So the idea is primary dealers play a very important role when it comes to liquidity of an auction, and also ensuring that the RBI auction becomes a success. Naturally, primary dealers receive a certain fee from the RBI for participating in the auction, but primary dealers actively do that. So whenever there's a fresh issuance of securities coming in, they participate, they procure the securities. So whether they subsequently want to hold on to those securities or trade it in the secondary market, that's completely their decision. But the idea is they ensure that there is ample liquidity and demand for the new government securities, and the securities auction becomes a success. So that's why PDs play a very, very important role in ensuring that. And this is what you call as primary dealerships. Now, PDs can be of two forms. So there can either be standalone dealers or there can be bank PDs. So standalone dealers example can be, let's say, Morgan Stanley PD. Morgan Stanley doesn't have a very active banking network in India. So that way we call it as a standalone PD. Whereas maybe another example can be possibly STCI, even Goldman Sachs. All of these you can assume to be standalone PDs. And then you have bank PDs. So something like ISEC from ICICI Bank, or you can have PNB Guilds from Punjab National Bank, etc. Now, all of these, again, they do a similar role. They participate in auction of government securities and all the subsequent activities, but this is the difference between a standalone PD and a bank PD. Now, uh, so now we introduce what are primary dealerships. So now we know that, and these are important entities, and also they can be good revenue generating units for the for the bank who owns the primary dealership or any standalone PDs as well. So this is the idea of a PD. Now, also, were you guys introduced to the idea of SGL accounts and CSGL accounts? Subsidiary general ledger and consolidated subsidiary general ledger and current accounts. So, were these terminologies introduced as a part of your capital markets class?
No, sir. I don't think so.
Okay, okay. Uh, so, when we talk from a primary auctions perspective, whenever anyone wishes to transact in the primary market, uh, you need to hold a SGL and a current account with the RBI. So primary dealers, that is those who are authorized to transact in the primary auction, and a few other entities in the market who hold that license to participate in primary auction of government securities. They hold a subsidiary general ledger or SGL account and a current account with the Reserve Bank of India. Now, SGL account you can imagine is a securities account, or you can imagine this is similar to your demat account, whereas a current account is your bank account. So, whenever a primary dealer is bidding in the auction of government securities, and whenever securities are allocated to a primary dealer, then those securities come and sit in the demat account, which is your SGL account, and the payment happens through the current account which they are holding with the RBI. So the payment gets transferred through the bank account, and securities are transmitted through their SGL accounts. So for anyone who is holding the license to enter into a primary market for purchasing government securities needs to have these two things in place: an SGL account and a current account with the Reserve Bank of India. Then there is a CSGL account, because not every participant has that license, because those licenses are limited. Not everyone can participate in primary auctions. Now, gradually, RBI is also opening things up so as to improve participation from retail investors. But still, not everyone has that license to enter the primary market. So others who are interested and wish to transact in the primary auction can hold a CSGL account. Now, the CSGL account is not with the RBI. Now, what I can do is I can approach, let's say, PNB Guilds Limited. Let's say I'm a retail customer. I go to PNB and I tell PNB Guilds that I am interested in participating in primary auctions, but I don't hold a license to enter into the primary auction. But you hold it because you are an authorized primary dealer. So we want you to bid on our behalf. So for that case, what I need to do is I need to open a CSGL account with PNB Guilds, and my bids are something which PNB Guilds will pass on at the time of auction. If securities are issued in that auction, then PNB Guilds will transfer those things to my CSGL account, and I need to make a payment to PNB Guilds for that purchase. Once I receive those securities, I can subsequently start transacting them in the secondary market. So this is what you call as a CSGL or consolidated subsidiary general ledger account. So these are three things or three items which are primarily considered whenever you talk of participation in primary auction. So any questions on this? Also, there is a popular system for bidding on the primary auctions platform. It's called as eKuber. So eKuber is a popular platform through which market participants can bid in the primary market. You can generally go through features of eKuber, etc. They will be available online. So something which was introduced long time back, but it's a very popular tool and something which market participants use very, very often. Okay, so anything else which we can cover here? So we have primary, secondary market, auction, career. I think this is good. Fine. So any questions on any points up till now, either this slide or the previous one or the one before that. So anything which we have, any queries on things which we have discussed up till now from the start of the class? Okay. Then there is a concept of, now let's try to understand yields. So when you say yields, it's basically you're talking of interest rates. So let me switch to my whiteboard. Now the next few points, I'll just read from here, and I'll show it to you on the whiteboard because the space here will not be enough to explain those things. So let me just open Paintbrush. Let me just share screen. So when you say yields, that's basically you're talking of a yield curve. And when you say a yield curve, it is nothing but a plot of tether versus yields. So typically your yield curve can look something like this. So let's say 1 week, 1 month, 6 months, 1 year, 5 year, 10 year, and so on. And for each, we have a certain yield. So yields, you can imagine, is a synonymous term which we use for interest rates in the market. So yields are something which will keep on moving. So depending on the conditions in the market and depending on the demand and supply for securities, market yields are going to get impacted. So along with this, various other things like what are actions from the central bank, what is globally happening, etc. Everything has an impact on yields. But you can imagine that this is like a market-driven thing. So this can be like your primary input for majority of the models. And if you want these closing yields, naturally, I mean, FIMDA is one of the places, but otherwise, you'll have closing yields which are available on Bloomberg or Reuters as well at the end of every day. So this is also what we call technically as a yield curve. A simple plot of tenor versus yields at respective time points. Now, these yields for every currency are quoted at specific tenors. That is, I will not have the yields for every single tenor which I expect. I have yields for 1 week, 1 month. I mean, there may not be anything between 1 and 6 months. Now, there is a 3-month point, but for now, assume that 3 month doesn't exist. So from 1 month, directly we have 6 months. After this, we directly have 1 year, etc. So that way, these are like standard time points or tenor points at which we quote yields. So yields are not quoted for every single day. It's simply not possible. Market will always quote only those yields which are liquid enough. That is, those liquid tenor points are quoted, others are not quoted. Now, the idea of interpolation. So is everyone familiar with what is interpolation? Have you used
Ye-
interpolation before?
Yes, sir.
Okay. Uh, so, so let's say I have tether and yield, and let's take a small snapshot of this. So let's say I write 1M. Let's say this is 4%. I'm just putting hypothetical rates. Let's say 6M is maybe 5%. And let's say my target is 5 months rate. So this is my target. Imagine this is like a question mark, which I'm trying to solve. Sorry. So this is an example of interpolation because I have two terminal points which are available to me 1 month and 6 month. And based on this, I'm trying to figure out what is the 5 month yield. Now, 5 month yield may not be quoted because let's say it's a non-standard maturity. So I'm trying to figure out something in between. And this is what we call as interpolation. So in Excel, you have a ready function which does interpolation for you. So have you used that before?
No, sir.
Okay. Of course, you have that long formula R1 and R2, which you can combine and do simple linear interpolation. But in Excel, you have a very convenient function called as forecast, which you can use for solving for this 5 month rate. So you can try this out later. So this helps in linear interpolation. Now, there are a couple of types of interpolation techniques. One, so were you introduced to linear interpolations and spline interpolations?
No, sir.
Okay. So what we generally do when we talk of interpolation is a linear interpolation. So this is like a by default. When someone says I'm interpolating something, they do it the simple way, the linear interpolation. So when you say linear interpolation, you are trying to use a straight line measure. So maybe something, so you can imagine this to be like similar to an equation of straight line, something which we use otherwise as well. So this is also what we call as a linear operator, isn't it? That is, here we are simply trying to fit a straight line. That is, given coordinates x and y, I simply try to fit a straight line and then I calculate the slope, etc. So this is what we call as a linear operator. So anything which is of a straight line, we call it as a linear operator. So a similar idea we'll use for linear interpolation also. So let's say I have these 2 points. Let's say this is 1m and this is 6m. So when I do a linear interpolation, what I do is I simply fit a straight line between them. So these are my two yields which are given to me. So if I have to interpolate anything in between, I can say that this is a straight line and I can take a cross section. So let's say 5 months is here. So if this is my 5 month cross section, then this orange cross becomes my 5 month yield. So this is what I call as a simple linear interpolation because it's a straight line measure. Now, this may not always be the most best approach of doing things. So can you think of a scenario whereby linear interpolation may not give you a decent enough estimation? So I'm trying to again figure out this 5 month yields, but can you think of a scenario whereby linear interpolation may be unsatisfactory?
So if it is a wider time period that we're taking into consideration, like if
Oh,
I'm taking 1 year and 10 years, so that doesn't make sense if I'm like, trying to figure out what's there for me in the fifth year.
correct.
So
So tether is one. Yes. Anything else whereby linear interpolation might not give you a satisfactory estimation?
So just to add to what Rahul said, maybe if we can account for shocks or anything like that that we're expecting to happen.
Correct. So
Something
maybe if I
something like
just
a war breaking out or something.
rephrasing your response, if I have curvature, correct. So both of these again good, very good, and relevant points. These are a couple of points whereby simple linear interpolation may not be useful. So tenors definitely, because if I take a very long tenor, and if I compare 1 year versus 10 years, as you mentioned, and that is definitely using simple linear interpolation can be risky because it's a very long time difference between. I mean, the duration is big, 10 years minus 1 year. So that way, you fitting a plain straight line can be risky there. Also, for curvature, now whether your curvature changes, now it may not always be a parallel yield curve, right? You can have humps and changes in curvature which happen. So in that case as well, I mean, plain linear interpolation might not be useful. So I think there is something. I think someone raised their hand, is it, or someone pinged in chat?
sir, I wanted to ask something.
Yes, yes, please go ahead.
Sir, if we are comparing two different fixed securities, so would there be like, interpolation a valid thing to do? Like if I'm like comparing with respect to relative prices.
Mhm.
So can I interpolate there for two different securities?
So you can, because finally the thing is, you whenever you talk of yield curve, you're basically looking at interest rates at different points in time, right? So that way you're anyways looking at different tenors. So these are my yields and these are my tenors. So this is what I technically call as my yield curve. So I have yields at different time points. So that way, naturally, you'll have different securities which are transacting in different regions. So maybe if I divide this into three parts, I can have this shorter zone, maybe the longer zone, and the mid zone. So that way, I have different securities which transact in each of these zones. Now, again, this zone is only for our analysis. We always look everything in a continuum. So we are starting from the shortest maturity up to longest maturity securities which trade. And we have yields for every security which transact, and we try to use all of those yields to construct the yield curve. So when I say a yield curve, you can imagine it's a combination of different securities.
Okay, sir.
So again, coming to our discussion, if I have curvature, then this is something which may not be good enough. So if I had to maybe show it again, let's say this is 1 month and 6 months, and I have my cross section here, which is the 5 months point. And let's say this is the earlier measure which I do, the plain linear one. But in reality, say that there is a drop in yield. So actually the yield curve shape is something different. Let's say it is something like this. So let's say green is the actual yield curve shape which you observe. So actual shape could be something like this. So what would happen is if I use plain linear interpolation, I will end up saying that this blue color cross is my 5 month yield. But in reality, your 5 month yield is somewhere here. So this is the true yield for 5 months. So what has happened is there is an error which I've introduced here. So this difference is my error term because I've used the incorrect interpolation technique. So that's where whenever you have curvatures in the yield curve, a plain a plain linear interpolation is not good enough. Now there's no fault of linear interpolation here. It's a plain linear measure. It doesn't understand curvature. It's the shortcoming for that particular interpolation technique. So this difference is something which may not be acceptable. Now, how much this quantum is acceptable, that's a different thing. But generally, what people do is they have a slightly higher order calculation, which they use, which we call as a spline interpolation. So rather than using something like a linear operator, they may want to use something which is of a higher order. So maybe something like a quadratic. So maybe you could have something like y equal to ax square plus bx plus c. Or maybe you could have a cubic spline as well. So something like ax cube plus the other terms. So the advantage here is I have higher order terms, right? So I have something which is greater than x raised to 1. And the advantage is whenever you have such higher order terms, that gives you additional flexibility because something which is of a higher order naturally understands curvature. And that is meeting our purpose because our purpose will not be met if we use a straight line operator in this second scenario. Straight line operator will give us errors in our estimation. But if I use a spline technique, either a quadratic or cubic, I'll be easily able to track these things. And this is where spline interpolations get used. And this is how you can differentiate between a linear and a spline technique. And generally, you'll observe that most traders and risk managers will have both of these calculators ready. So as a part of the calculation, they may have a simple drop down. So they can see what is the linear value and they'll just change the drop down and they'll have a spline interpolation value as well. So which one to use is their decision, but both of these options are generally available. So any questions in this?
Yes, sir. So because yield is a function of time and obviously shocks in the market. So this, the second kind of interpolation that we're talking about. So would the system automatically update it with respect to the data that's fed into it? Like the
Uh,
curvature would automatically be updated because if I'm taking a particular sort of transformation that might not fit with with what's going in the market. So
okay. So again, if you're doing plain interpolation here, you don't really have to worry about in the machine learning bits here. So I think your question might be coming from the fact that if I had to apply a certain machine learning algorithm, will it be able to understand what is happening in the market and will it be able to fit the model correctly? So is that
yes,
was
sir.
that
So
the
would
idea?
the curvature automatically be
Correct.
adjusted with respect to market? That's what I wanted to understand.
Correct, correct. So yes, so to answer your question in short, yes, it will get adjusted. So I'll tell you why. Because this is like a standard formula which I'll be using. So what I do is I pass the, so again, So you're good. I mean, you're a step ahead. So that I was getting there. So in cubic spline, what you do is you have to plug in the entire yield curve. So this is a principal difference between linear and spline interpolation. So for cubic, what I need to do is I need to pass the entire yield curve as the input. So let's say 1 week to 10 years, this is my yield curve. So when I am calibrating my model, I need to pass the entire yield curve as the input. So the entire chunk has to go in. That is, the model has to have the information of all the yields available up till 10 years. And based on this, model is going to calibrate the parameters. So I have something, let's say like a cubic or maybe a quadratic, ax square plus bx plus c. So model is accordingly going to calibrate the best fit values for A, B, and C, which we normally use while fitting a certain model to data. So this entire yield curve is used and model calibrates ABC. Now this is in contrast to what happens in linear interpolation. Now if I take a linear interpolation and let's say I am actually interested in just the 5 month point. So what I can do is I can just take a snapshot. So something like this, which I demonstrated earlier. I just take a snapshot of 1 month and 6 months, and that is it. I don't need to worry about other yields because it's a plain linear interpolation, and these 2 points are good enough for me. But for spline, that is not good enough because for spline, we are trying to fit an equation. So the model needs to have visibility of the entire data. And based on that data, model will calibrate the best fit values for parameters, and then it will get used in the analysis. So does this answer your question?
Yes, I understood.
Okay. Any other questions for anyone? Okay. Also, and something to do with the power of the equation. So would you like to comment on what should be the highest power which I should apply to my equation? So should it be quadratic, cubic, or maybe fifth order, seventh order, ninth order? How I mean, do you have any view on that? I mean, how would I decide which order should I go in for? So maybe should I go in for a higher order one, or maybe a lower order equation is better? What do you think? So let's say I give you a choice that you have to fit a cubic, or let's say you have to fit a spline, and I give you a choice that you can select on order of 3, or you can also select on order of 7. So given this choice, which would be your preferred technique? Would you like 3 or would you like 7? So think from your
So,
overall model calibration, etc.
so I think order 7 would have deeper curvature in the sense that I would be able to analyze better in terms of the risk associated with the yields.
Okay.
So a higher order might provide us better value with respect to the curvature.
Okay. Okay. Any drawbacks of this higher value, which anyone can think of? So flexibility, yes, it's an
But it
advantage.
increases the spread of the yield that I'm trying to analyze. So that can be a drawback. If the curvature is higher, so the spread for the yield would also be, the range that I might be analyzing would also become broader in the sense the range will increase. So could that be a problem?
Not really. We'll talk about that. So that won't be a problem exactly. There is some other problem, maybe something which you have studied as a part of your business analytics class. So can
So
you
can I
relate
try?
that? Yes, please.
So, sir, the higher the order which I choose, simple language, I'm gonna have more and more curvature on my curve, right? But then when we are forecasting, we have to always account for a certain error. Sometimes it's better to be a little bit vague than to be extremely specific.
Correct. So technically, and
So I would
as
go
a
for the lower order, sir.
correct.
I think
Okay.
so.
Okay. So technically, do you remember that term which we use to we should ensure that the model does not become XYZ to the data. So
Overfitted.
absolutely very good. Thank you very much. So there is a problem of overfitting data whenever we are using higher order. So yes, and by looking at things, we may quickly say that a higher order is better. I would like to go in for order 7, but that is something which you need to do with a lot of care because the thing is, higher the order of the equation, the greater the flexibility it is. Also, I mean, as Ali rightly mentioned, I mean, there will be error terms which will be introduced, because finally what will happen is your equation will look longer. It will be y equal to ax raised to 7 and other terms. So that way you're trying to figure out multiple coefficients, and naturally you'll have a certain error term in the end. So estimating so many coefficients can introduce some additional errors in your calculations as well. Yes, advantages, it has a lot of flexibility. So it has on order 7, so it will be able to track the yield curve exactly as it is. But then you're risking yourself to the problem of overfitting of data. So when I say overfitting of data, that basically implies that your model has been tuned in such a way that it understands the current data really well. So is everyone familiar with the idea of in sample and out of sample testing? So have you used in sample versus out of sample as a part of your machine learning? So have you guys been introduced to that idea of test, train, and split, or train, test, and split?
Yes, sir.
Your
Yes.
Train test.
correct. So in train, test, and split, you use the idea of in sample and out of sample testing. So basically, you have this a certain training set and you have a testing set. You may have a separate validation set as well. So let's not worry about that now. So you split your data into two parts. You train your model using the training data set. You optimize the value of your parameters. So while training, your model has no idea of what is the testing set, because this is invisible for the model at that point in time. You don't allow model access to that data. Once your model parameters are set, then you apply it on the testing data, and then you see the performance. Now, if your testing performance is good enough, then you say that the model fit is as per your expectations and the model is behaving well. So this is what you call as out of sample testing. Why I say out of sample? Because this data is something which was not there in my initial sampling. So my model doesn't have access to this test data. So while testing your data, you should always test your data against out of sample data. So when you say overfitting, that means your model has been tuned in such a way that it will be heavily dependent on what data it's working on. So one of the examples can be to show overfitting. Just delete this much section. So let's say my yield curve is something like this. So let's say this is my yield curve. So let's say with an order of 3, I may have something like this. And slightly extreme, this imagine this green line is closer to the dot. Whereas with order 7, I could have something which is very, very tailor-made. Something with order 7 will pass through every single yield point which I have. So this is order 7, and this green line is order 3. So here, if you see, the green line has some errors introduced in that, yes, but an order 7 is exactly tracking every single yield point. Now, the problem with order 7 is it is heavily dependent on the data. That is, it understands this data really well. It understands it in and out. So maybe with order 7, your accuracy could be 99.8% or something. Maybe with order 3, your accuracy could be around, let's say, 90 or even 85%, whichever. But the idea is your order 3 model would be comparatively more flexible whenever you expose this model to random data sets. So your yield curve will keep on changing every day, right? So that way you want to have a model which you can stably use across the yield curves. So that way, if you keep it very, very sensitive to the data, then handling that model from a model overfitting perspective can become difficult. So generally in financial applications, we do not go beyond the order of 3. So quadratic or cubic spline. Cubic is good enough for most of the applications. Now for non-finance, I don't know, there may be higher orders which could be useful, but for financial applications, we try not to breach order 3. And the reason behind that is we try to avoid overfitting or the risk of overfitting. So you'll observe that most authors will try to stick to a quadratic or a cubic spline technique. They will try to avoid any higher order terms. And this is the idea behind avoiding higher order terms. So does this sound okay?
Yes, sir.
Okay, okay. All right, so we're at 10:20 now. So should we take a break for 5 minutes and come back? Yeah, so it's 10:20. So let's regroup by 10:25 and we can continue our discussion ahead. So let's take a 5 minute tea break and we'll be back. Hi guys, can we restart? Is everyone back? Can we proceed?
Yes, sir.
Okay. Uh, Now we can introduce ourselves to the idea of price versus yields. So, from newspaper reports, which you recollect, how are price and yields related? Are they directly related? They are inversely related?
So inversely related.
Correct, correct. So, we'll see why this is true as well. So, typical price versus yield chart is something like this: price versus yields. This is like a typical price versus yield graph. So, we have seen interpolation of yields. So, now we can try and relate this with prices. Now, let's take a plain government security. So let's take a GSEC or a treasury security, which has, let's say, a tenor of 3 years. For simplicity, we'll assume the coupon as C percent or maybe C units. So I'll just write this. I'll just write coupon equal to C. Let's say the coupon is equal to C. Let's say the face value is equal to FV. Again, sorry. Let me write this face value entirely. Otherwise, FV equal to FV can be confusing. Let's say face value is FV. Let's say Y is the yields, and let's say the frequency is annual. We'll keep it simple so as to avoid any adjustments which I have to make for compounding, etc. So we'll keep the frequency as annual. Now, my idea is to calculate the bond price. Let's say I don't know this price and I wish to calculate this bond price. How do I do that? There's a simple formula. We'll write the formula and we'll try to understand, which will help us also relate to this inverse relationship which is written. So we have a bond price P, which is equal to. So let me write the relation first and then we discuss. So P is my bond price, and on the right hand side, I have written the individual cash flows. So why I say cash flows? Because I have written coupons and the final face value. So this is also what you call as cash flow. So you can say this is my cash flow one, this is cash flow two, and this is cash flow three. And these time points are 1 year, 2 year, and 3 year. So this is my bond structure, and this is how I can write the bond pricing equation. Now, a bond price is nothing but the discounted value of its future cash flows or its future coupons plus whatever cash flow, coupons plus face value. So we'll keep it generic as cash flows. So bond price is nothing but the PV of its cash flows. So I would like to say P, if I had to generalize this, so the summation of I equal to 1 to n of individual PVs of cash flows of I. So I would like to write the bond price in this way. Now, why this equation and why we call it as the discounted cash flows? Because let's focus on the first year cash flow, the 1 year one. Now, if I look only at the numerator, imagine that the denominator doesn't exist. Then the numerator, can I say it is like a non-discounted cash flow? If I ignore the denominator for now, if I just write it as C, can I say it's a non-discounted cash flow? That is, it's the coupon payment which I know of, which I'll receive in 1 year's time. Now, let me write the term in entirety. So let me write C upon the denominator. So when I divide this C by the denominator, can I say that this term is nothing but the PV of cash flow 1? Would that be okay? So this is just discrete discounting. But does everyone agree that this term, this green bracket or this green block is PV of cash flow 1? Would that be correct?
Yes, sir.
Yeah. And hope everyone is comfortable with continuous and discrete discounting. So something which I write as C upon 1 plus Y raised to 1 is equivalent to C into e raised to minus y into 1. So this is what we call as the discrete discounting. This is what you call as the continuous discounting. So here I just use discrete discounting. But either ways, whichever relationship you use, you'll end up with a similar value. Maybe the answer could vary probably in the fourth decimal or so, which is fine. But otherwise, logically, they're exactly equivalent to each other. So this is PV of cash flow 1. Then I have PV of cash flow 2 and final PV, which is cash flow of or the PV of coupon plus the face value. So this is what I call as the bond price was or bond pricing equation. Now, why I say that this relation is correct? Now, not just because so we don't have to rely on what newspapers tell us. They say it's inverse, but why it's inverse? That we can quickly understand through this relationship. Now, if you say that the yields are falling, that is, let's say Y is dropping. If yields are dropping, my denominator values are dropping. So if my denominator values are dropping, I'm naturally dividing by a lower value. That is, my discounting factor is coming down. If my discount factor comes down, my bond price is expected to go up, isn't it? Because if I divide by smaller values of 1 plus y, naturally bond price is going to rise. That's why we say whenever bond yields fall, bond prices rise. Contrast, if I have a rising yield environment, so if yields are rising, then I'm dividing by a higher number. That is, my discount factor is also going up. Just other way of putting the denominator. So if I'm having a higher discount factor or a higher denominator, as you like it, if I'm doing that, then naturally the PVs of my coupon payments or the cash flows in general is going to come down. So because of that, when the yields are rising, bond prices are going to fall. And because of this relation, we say that the bond price is inversely proportional to yield, which is visible from this formula which we have written here. So any questions?
Sir, what causes the other? Rise in prices result in foreign yield, or is it the opposite?
So actually they are related. So traders will generally quote market yields when they trade with each other. But yields and prices, and they are very interrelated, as we can see from the relation. So if we are quoting yields, then we'll try and imply a price from that yield, and accordingly we'll see the movement. But that relation will remain stable no matter how you look at it, whether you look at it from a price perspective or a yield perspective.
Sir, on
Okay.
what basis is the discounting factor decided?
So these are your market-driven yields. So here we have taken a plain government security. So I'll look at my government securities yield curve and I'll uh, use that as a proxy for Y. So let's say I want to calculate bond price. I can look up my yield curve. Let's say I have a certain value of yields which I want to use. I can plug it into calculator and I can get price. The other way around is I can imply yields as well. If I have a quoted price for a bond, then I can solve for this equation with unknown value of y and I can figure that out. So basically you can do it either this way or that way. But that's how you can approach yields. Either have direct access to yield curve and use it, or maybe look at the traded price and try to imply yields.
Sir, but isn't it the fact that the discounting factor is a subjective and may differ from trader to trader, person to person?
Uh, Not really, because finally, yields will drive your prices, and traders are going to transact the bond at a certain price. So, at a certain price, you'll have a unique value of yield which is being used in the analysis. So, as the yields fluctuate, naturally prices will change. But finally, whatever so imagine at a certain point in time, if two traders are transacting, then they will use a same price at which they are transacting or a price which is very close to each other when they are transacting, because this is a over the counter market. So everyone may not trade exactly at p, but even if one trades at p and other trades at p star, for a plain vanilla bond, p and p star will be very close to or even equal to each other at that particular point in time.
Okay, sir, thank you.
Any more questions for any?
Sir, this relationship is valid in short run and long run. Sir,
Yes.
if say for example a bond is giving higher yield compared to other bonds in the market, so ideally, people would want to have more of that particular bond because it's assumed that this particular bond is giving me a higher yield or higher returns. So people would want to demand, so the basic supply and demand relation there then becomes as the demand is increasing, should the price not go higher in the short run? Because a lot of people are driving the force towards that particular bond. So the price should get even if the yield is increasing in the short run, the price should also go up. If
Uh, that ideally won't happen because when you talk of yields, that is another measure of understanding what is the riskiness for a certain bond. So as your bond gets riskier, your yields also start rising. Why we say that? Because if an investor is willing to take on risk of purchasing a certain bond, they will expect a higher yield. So let's say there are two bonds. One is maybe a triple A rated bond with a yield of let's say 4%, and then we have a B rated bond. So let's say my triple A has a yield of let's say 4%, and a triple B or maybe a B rated bond has a yield of let's say 7%. Now you'll see a higher yield here. So I mean, just by looking at this much, if we just ignore the ratings, we may say that the 7% thing looks really attractive, so we can go in for this. But along with that, investors need to take into consideration the credit risk which is embedded in these particular bonds. Now, a triple A rated bond is far safer from a credit perspective as compared to a B rated bond. So that's why whenever investors are willing to accept or willing or expect a higher yield, then they always know that there will be a certain additional risk which is embedded there. Because investors will say that we are purchase. So if a issuer comes up with a new issue and there is a certain risk of maybe potential credit default from the issuer, then investor will say we are taking a risk on you. We'll be purchasing your bond, but we'll purchase it at a cheaper price. That is, we demand a higher yield from you because we are taking a risk on you. So they will say we will purchase it at 7%. We are not okay with purchasing your bond at 4% because firstly you are not rated AAA. There is a credit risk embedded in you. So tomorrow if you default, we are going to bear the brunt. So if we are taking a risk, we expect compensation. So for that, we expect a higher yield. So that's how you should look at comparing bonds across whenever you have to look at it from a yields perspective, not just the yields number, but also the ratings and other factors.
okay, sir.
Another question.
Yeah.
Uh, Sir, so so right now, so if I'm to issue bonds at 4%, that is going to be a fixed rate, otherwise a flexible rate that is going to be linked to a particular government security, right? So are there any
Uh,
such products that are linked to your rating as well?
so the thing is, again, your ratings will keep on changing. Now, again, the ratings will not change very frequently. Now, ratings generally get updated maybe every couple of months or every quarter for that matter. But yields are something which are very, very responsive. So I would say that ratings are something whereby your refreshing frequency is lower. You don't refresh it at a faster rate because credit rating agencies will not update or will not have a new rating available every day. That's not possible. But yields are something which are very, very responsive. So I would say based on the riskiness of your bond and also based on the demand and supply for that particular bond, yields are going to get impacted. So I would say these are market driven factors. So your yields are market driven. So as market yields or as the market conditions change, both demand and supply conditions as well as the risk conditions for a certain bond, your yield movements will also happen. So today, when you're issuing the bond, the yield is 4%. But tomorrow you never know. I mean, based on the demand and supply, your yields could rise and drop as well. Or maybe 6 months down the line, if your company starts running into problems, yields may further rise as well because then the market is not very optimistic about your firm. Or in contrast, in 6 months' time, if your business even further improves, then market may be confident and your bonds may start trading at a premium. That is, your yields would drop. So I would say there are multiple factors which are going to drive the yields, but mainly these will be market driven factors. And of course, when I say market driven, based on the condition of the issuer, also uh, the overall it will have some impact on yields.
But then, sir, yields will affect the secondary market. But if I am the issuer of the bond, then it doesn't matter for me, like whether my company goes to B or even a C or a D. Once I've raised the money, right? So then that's a conflict of interest because if you see even in all these recent IPOs as well, financials are shown to be very, very strong. immediately the next quarter there's a huge dip. So I imagine something similar might be happening in the bond market as well, right? Because I'm not going to be raising funds every day. I'll be raising it once in 10 years, and like it'll be a huge amount.
So the thing here is your investors can come back to you asking for early redemption. So you may have, let's say, a 10-year horizon in mind. But if your investors last start losing confidence, they may come back to you saying that. So there may be so they can trade or sell their bonds earlier as well, right? So your investors or traders in banks may say that we don't really trust this issuer anymore. We want a redemption for this thing. So they may either trade this bond with someone else who may ask for redemption, or they may personally file for redemption. And if they file for early redemption, that naturally has an impact on your bond capital. So for any issuer, holding a decent credit rating is important for a variety of things. Firstly, deterring investors from early redemption. That is, they stay on as your investor, so your overall capital ratio gets managed. Secondly, there can be certain covenants. So there can be a negative covenant which says that if your credit rating falls below so and so, we can start certain action against you, or we can file for redemption of our entire chunk of the bond. So that can be like a huge shock for the issuer, because that way, if your entire set of investors who are holding that bond come to you for redemption, then that's like an immediate cash outflow which happens, and your overall debt funding suddenly drops. So that way, issuers are very, very concerned whenever they're looking at credit ratings, and everyone wants to maintain a good credit rating. Another related application for credit rating could be whenever you have to raise any funding. So let's say tomorrow, if you go to a bank for borrowing, or let's say tomorrow you go to the market for further issuance of bonds, market will always look at what was your performance earlier. That is, whether you're defaulted, what was your overall ratings profile, whether it has changed significantly, etc. And all of that will have an important bearing on what your borrowing costs are going to be. That is your incremental borrowing cost, both from a bank's borrowing or a bank loan perspective, as well as from new bond issuance. So that's why issuers will be careful about maintaining a good credit rate.
Okay, so that's what was actually on my mind, because otherwise you can just raise your credit rating suddenly, 1 quarter, 2 quarters, and then suddenly you can, like, once you have your money, you can do whatever you want.
Correct, correct. But no, investors can come back to you. Yes.
Okay, sir, sure. Thank you.
Any other questions?
Sir, what you said about redemption, can it be said right now Russia is facing the same, since their interest payment has been defaulted as of Saturday?
So again, that is like a country risk which we are currently looking at. So maybe from a country risk perspective, yes, at the moment they are facing some problems, but later on, I think this is more of a short-term or to medium-term thing. Because if you see, France and Germany have already declared that we are going to continue importing oil and natural gas from Russia. So I don't think this conflict is going to last for a very long time, because there is a heavy dependence on Russia. So even from the geopolitical tensions will gradually drop, because honestly, Europe is importing close to 40% of their oil and gas from Russia. Now it's good. America is okay; they are sitting on one side of the continent; they are not bothered. But for Europe, and they can't really ignore Russia. So I would say, although Russia is into problems right now, especially in this example, that problems are very, very short to medium term in nature. Now, these economic sanctions, etc., all are fine. They may have some effects on the economy, but it's a very large economy, especially with the natural resources Russia has, and they can tide over things pretty quickly. So I would say things will gradually normalize out. So they may default on maybe a couple of other commitments as well, but in the long run, I think they will stabilize.
Okay, sir. Yeah.
So one last question: where
Yes.
can I read about the different terms and conditions that come with a particular bond? Like you said, no, uh,
Yeah.
there's an option for
So
redemption.
that is something which you can go inside any bond prospectus. So any traded bond which you see, you can download the bond prospectus from google.com. From Google, it will give you the reference. And from there, this bond prospectus will be a PDF document. And inside this PDF document, you will find offer details. So offer details will be one of the sections which will give you in detail what that bond is. So what is the face value? What is the time to maturity? what is the credit rating, what is the coupon, are there early optionalities, etc. All of these things you will get inside a broad bond prospectus, and that is freely downloadable and freely available for all publicly traded bonds.
Okay, sure, sir.
Any other question? Okay. Okay, so this was bond price. So let me read the next point. Yeah. And there's something which we call as credit spreads. So credit spreads are one item which we use to adjust for credit risk, which is embedded in entities. So when I say a credit spread, you can imagine it's like a fixed spread S, which I'm looking at. Let's say I call S as the credit spread. So again, just giving you an idea, so FIMDA publishes what you call as a credit spread matrix. So it's a simple Excel sheet which is published on a daily basis by FIMDA and which is to be consumed by banks on a daily basis. It's a regulatory requirement. And it could be something like this. So you have tenors, or maybe you have ratings along the column, and you have tenors here. So your ratings could be, let's say, AAA, AA. If I recollect, FIMDA publishes up to triple B. Is it up to so AAA? I think it's up till B rating, if I recollect. So FIMDA publishes things up till rating B, and you'll have a credit spread. So you'll have 6 months, 1 year, 1.5 year, and so on. And this goes on up till 5 years, if I recollect. And you have certain numbers which are plugged in here. So all of this matrix will be filled with numbers, which we call as the credit spreads. And FIMDA will publish three matrices, namely, one will be for banks and financial institutions, corporates, and NBFCs. And these matrices will be available around 7 p.m. daily. So if you go to FIMDA's website, of course, now right now you won't be able to download the fresh matrices because you require membership or you require an account with FIMDA. So most of the banks have this login with FIMDA. So I think it's like a yearly subscription which they have to do with FIMDA, so that they can download and use all of these spreads on a daily basis. Now it's a regulatory requirement for them, so they have to have the membership with FIMDA. So every day in the evening, FIMDA publishes this matrix around 6 or 7 p.m. and which is consumed by banks as a part of their enterprise risk system. And then it is used for all the subsequent calculations. Now, the idea behind the credit spread matrix is to capture the credit risk which is embedded in non-SLRs, or what we call as non-government securities. Now, anything which is on the GSEC side, we assume it to be default free. That is, it is assumed to be a secure investment. So, any investment which you make inside an Indian government bond, you don't have to worry about credit spreads because you don't expect the Indian government to default. Worst case scenario, government can go out to the open market. So not exactly open market. They can go to the RBI and RBI can print notes for them, and that can be used for making the repayment. Of course, that's a very extreme scenario. That will not happen because if RBI starts doing that, inflation will start rising tremendously. But of course, that's a last resort, isn't it? So government won't default on their commitments. But otherwise, I mean, if you compare this with a non-SLR or someone like a corporate bank, NBFC, etc., then they have a chance of defaulting because their bond commitments are based on their business model. Now, as long as their business model is robust enough, no problem. That business will generate ample amount of revenue and funds, which will be used for meeting all of their commitments on the bonds, that coupon and final face value, etc. But if their business runs into a problem, then there is a chance that a certain company might default partly or fully on their bond commitments. So maybe a few coupons could be lost, or maybe the company would say, we are filing for bankruptcy, we don't have cash, or our business model is not working, so we can't repay back. So that will be like a full default. So that is something which we try and understand through credit spreads. So credit spreads are used to capture this credit riskiness, which is embedded in respective bond issuers, or I would say bond issues. So that is what we call as credit spreads, and this becomes a proxy for credit risk for a certain bond. So does this sound okay? Okay. So up till now, so when I say up till now, I think roughly up till 2018. So I think up till around 2018, FIMDA used to publish this fortnightly. That is, every 15 days used to have a credit spread matrix. But now, since 2018, this has become daily. So every day in the evening, FIMDA publishes a revised credit spread matrix, which the market participants use for their calculations. And again, this will be like an automated batch process which runs. So most banks will have a batch process which will fetch these numbers. So your automated batch process runs, and this batch will go and put this data in your database. So you can assume this is like your enterprise database. So inside your enterprise database, the entire matrix goes and gets saved so that it can be used by downstream calculations. So this is how generally banks use these in calculations. Now, uh, whenever you're pricing the non-SLR bond, a small adjustment has to be made to the bond pricing formula. And that small adjustment is nothing but adjusting for bond spreads, because every bond will have a certain spread which is associated with that. So every bond will have a certain rating. So what we can do is we simply look up the ratings matrix, and then we apply a certain spread on top of it. So a small adjustment can be, let's say, I have just two cash flows on the bond. To simply, I could do it something like this. So earlier I had something like this, right? Now this was for my GSEC. What I do is I just adjust this for a spread. So this is how I can adjust for credit spreads, and this is how I account for credit riskiness which is there in my bond. So essentially what I'm doing is I'm adjusting my discount factor. When I adjust my discount factor, that is the other way of saying that I have factored in the credit risk in my calculation. Because since I'm increasing my denominator, or I'm increasing my discount factor, that is going to have an impact on my bond price, which is going to decrease. So that is one way of saying that I have captured the potential credit risk which is embedded in a particular non-SLR bond. So when I say non-SLR, it is basically anything which is non-government in nature. So for non-SLR, this becomes a valid formula. For SLR, you don't have to worry. For SLRs, you simply drop these spreads, because spreads for government are zero, because it's the benchmark, right? You don't have to worry anything about government defaulting. So for SLRs, don't worry about spreads, but for non-SLRs, yes, that kind of a spread adjustment is required. So maybe once you join your respective firms, if you happen to join a bank, you'll have access to these matrices. If you happen to join consulting companies, then you can request for this information from your clients, because consulting firms may not hold a membership, because they may not require this for projects day in, day out. So they would not really spend on the membership bit. But otherwise, if it's a bank, then yes, it's mandatory. So you definitely have access to FIMDA. And otherwise, so I think your earlier data or earlier matrices are available for free of cost. So maybe if you generally want to get a sense of what a credit spread matrix looks, maybe some historical data will be available. Now, just for academic purposes, you can definitely go through that. You cannot use it for today's pricing, but that's okay, right? You don't have a current bond which is to be priced. But just to get an idea of as to what the file is like and how exactly you can use it, that is something which you can generally go through, so that you know what is the credit spread matrix. So tomorrow, when you join a bank, you will already be familiar that fine, hi, this is the spread matrix which is used, and this is how I can use it in my calculations or use it in my system. The next one. Let's say matrix is done bond pricing generation pricing. So I mean, we'll not start with spot rates today, because there are a couple of concepts which we will start, but that is something which we'll do the next time. Today we'll do something else. There is a concept which we call as spot rates and forward rates. So something which we'll be covering in our session on Monday, because or Wednesday, because I would like to cover them together. So there's an approach or a process to calculate spot rate, something which we cannot cover in the remaining portion of the class, but something which we'll cover later. Also, just coming back to the credit spreads point, many a times you may have to interpolate spreads as well, because spreads are quoted at specific tenors. So if you are to have something in between, so let's say I want a spread for maybe 8 months, that is not quoted, right? So I look at 6 and 1 year and I can interpolate for 8 months. So that's how I can handle credit spreads also through interpolation. So I mean, just a related point. So something which I forgot to cover earlier, there is extrapolation as well. So have you guys done extrapolation before? Or do you do extrapolation often? Or maybe firstly, what is extrapolation? So have you heard the term along with interpolation? Okay, so extrapolation is basically trying to estimate something which is beyond your terminal point. So let's say this is my yield curve. Let's say I have 5 years, so and so, and 6 years, so on. And I wish to estimate what is the yield for 7 years. So this is like something which I'm trying to estimate. And let's say the market is quoting a maximum tenor of 6 years. Beyond 6 years, I have nothing. So this is my only available data, the above section. Below section doesn't exist. So this is the yield curve. Imagine this is just a snapshot, or maybe this is the terminal side of the yield curve which I am looking at. I may be having earlier yields also. But now 6 years is the is the longest tenor which I have. I don't have anything beyond 6 years. Now, if I want to estimate what is the 7 year yield, I may want to use extrapolation. That is, using the available data, I may want to extrapolate as to what the 7 year yields are. Now, extrapolation is something which has to be used with care, because for extrapolation, you don't really have a ending or a stopping point, isn't it? Because if you compare this with linear interpolation, we always had two extremes in which we were trying to figure out a value. But here we don't have any extreme. Now we just have a starting point 6 years, but beyond 6 years, it's blank. Market doesn't quote anything beyond that. Now there are two ways to handle this scenario. So imagine that you have a cash flow which is coming in at the 7 year point. So you need to somehow calculate the PV of 7 years, PV of the cash flow happening at 7 years. So one way to do that is naturally via extrapolation. Now, this may be one of the ideas of doing things. And other is to use the longest tenor yield quoted. So if you personally ask me, I would prefer the second approach, which is the longest quoted tenor yield, because the thing is, now why I say there are two approaches, because it's up to the valuer to decide which approach they want to use. If they're comfortable with extrapolation, then they may use an extrapolated value for 7 years, or else use the 6 year value and clearly mention in your report that this is the longest quoted tenor which is available, and that's why we have used this in our calculation. So either way, it's acceptable, but whatever assumption you follow, you have to clearly mention it in your report, because someone who is reviewing this report later on, say it is an auditor or a regulator, they may see that 6 years is the maximum tenor and the 7 year cash flow has been handled in some way. So naturally, the question is going to be how exactly you have calculated PV of the 7 year cash flow. So at that time, you have to clearly document what you have done, either use extrapolation or use the longest tenor. Extrapolation, I say, is slightly, maybe slightly difficult to justify, because you're trying to estimate something. So maybe there could be a certain set of assumptions which you're using, which you may have to convince the auditor or regulator. But other safer approach, which I've used in the past as well, I've used the longest tenor yield which is available. That is, if I have a 7 year cash flow coming in, but 6 years is the longest quoted tenor, that's it. Then I use the 6 year yield for discounting a 7 year cash flow as well. And I clearly mention in the report that since this is the longest quoted yield which is available, we have used that. We have not attempted extrapolation. So both are acceptable approaches. You have to clearly mention what you have done, and you should be able to justify, and if any questions come up. So does this look okay? Okay. So especially those of you who join these IPV type of roles, or maybe valuation type of roles, That is where you may have to come up with these things, either extrapolation or longest ever, etc. I would say these are slightly rare conditions, but yes, they can happen. So maybe you can pick one approach over the other as long as you can justify what you have done. All right. So we are close to 11, 11.5. So I think it's 11.5, right? Yeah, 11.5. Okay. So we can stop at this point because spot and forward is something which I cannot complete in 10 minutes. So something which we will cover the next time. So before we depart, let me take your attendance quickly. So do you guys have a long day today? Or so do you have sessions throughout the day, or how is it like generally?
Yes, sir. Back to back 3 lectures.
Oh, okay. So same like me. I also have one more session and I have a couple of client meetings. So I think it's similar for both of us. I'll also be occupied till 8 o'clock now.
Sir, can you suggest a reading material for bond math?
Yes. So I'll bring it in the chat. So a lot of things are given, or at least the required things are given in John Hull. If you do have time, you can check out Fabosi. Now, Fabosi is a very large book, so that way, maybe finding out Fabosi is more of a reference. So I would say that maybe if you have time, generally browse through, but otherwise, John Hull is good. And anything on fixed income, I would say, because there is a lot of reading content available online as well. So I think anything on basics of fixed income or anything pertaining to security analysis, portfolio management, I think that should be able to cover bonds to a considerable extent.
Okay, sir. Thank you.
So starting with financial economics, Akash Singh. Achal Jain, uh, Ayush Bhushan, Adyasha Hathi, Tejas Akware.
Yes, sir. Present.
Okay, Ali is present. Anjali Garg, Anmol Sen. Okay, Arismita Dekar,
Present, sir.
Avni Mishra, Ayushi Rotagi, Sarvesh,
Present, sir.
Bhavya Dang,
Present.
Cherry Chapra,
Present, sir.
Diksha Chauhan, Dipansha Singh,
Present, sir.
Gaurav Kadam.
Sir, Ayushi Rohadgi present.
Uh,
Ayushi Rohadgi present.
okay, okay. Ayushi,
Sir,
okay,
Gaurav Kadam present.
okay. And Gaurav Datir, Himanshi Verma is present. Jaideep Sen is present. K. Ayushi,
Present, sir.
Riya Shukla,
Present, sir.
Priti Marwa is present. Mansi Singhal, Simran Arora is present. Manvi Kukreja is present. Mihir is present. Muskan,
Present, sir.
Namrata Gaur is present. Neil Dar is present. Nikhil Agarwal,
Present, sir.
Prasul Sharma,
Present, sir.
Pratik Maheshwari,
Present, sir.
Rachit Tyagi, Rahul Ghosh, Rahul Giri is present. Rahul Goswami,
Present, sir.
Rajaditya Singh,
Present, sir.
Rashi Jain,
Present, sir.
Rishabh Kothari,
Present, sir.
Ruma Keshri,
Present, sir.
Sahaj Manocha, Sabiksha Chopra, Karanya is present. Shubham Jain is present. Shubham Kumar, Someshwar Verma. Shruti is present. Sanika Thakur is present. Vinay Pawar.
Present, sir.
Okay. Yeah, so financial economics class is done. If you guys have a session after this, you can log out.
Can you mark for Akash Singh, sir, FE?
Yes, yes, yeah.
Sir, Ali also.
Yeah,
Ali is
Ali,
absent.
I already marked you present, Ali. Yeah.
So you marked Shruti also?
Yes, yes, Tuti is also marked present. Yes.
Thank you so much, sir.
So request IB class to wait. I'll just take your attendance. FE class, you guys can leave if you have a session.
For Diksha Chauhan. I am with
Yes.
Vidushi.
Yes, yes, yes.
Thank you.
Okay. Thank you. So IB class, Ayush Sharma present. Alisha Gupta. Vidhi. Anand Jain. Anish Dopeshwarkar. Anjali Sethi.
Sir, she is present and even Arshada is here.
Okay, okay, I'll mark you both then. All right. Barkha Israni. Bhavya Patel. Saloni Bhujbal. Chaitra Tirodkar. Devam Pandey. Ikta Kalra. Gauraja Nevate is present. Gayatri Narkede. Govind Mittal. Savan is present. Himanshi Veermani is present. Indu. Ishita Saxena. Anika Goyal. Karthik Mittal. Asro L. Lakshay is present.
Present, sir.
Mahi Rajawat. Mansi Gupta. Mathangi Warrior. Megha Parak. Nancy Halawat. Neha Jain. Pratishtha Pradhan. Rohan Bagai. Rohit Podar. Samida Malik. Shivangi Semwal. Simran is present. Srishti Verma. Tanu Goyal. Tarang Kadyan. Kalyani Todkari. Twinkle Karnawat. Vaishnavi Shotriya. Vanishka Jain. Vibhor. Vidushi is present. Yash Mehra. All right. Yeah. Thanks, guys. Thank you so much. Thanks for joining in and wish you a good day ahead. And I look forward to meeting you on Wednesday. Thank you.
Thank you.
Thank you, sir.
Thank you.